This video is for informational purposes only and is not investment advice. Welcome to the fascinating world of stablecoins, where digital currency meets stability. Have you ever wondered how some cryptocurrencies manage to stay pegged to a stable value, like the US dollar, despite the wild swings of the crypto market? These are stablecoins, a unique class of digital assets designed to minimize price volatility, making them suitable for everyday transactions and as a reliable store of value. But what exactly are stablecoins, and how do they achieve this remarkable stability in a notoriously unpredictable market? There are primarily three types: fiat collateralized, crypto collateralized, and algorithmic stablecoins, each with its own unique mechanism. Fiat collateralized stablecoins, like Tether and USD Coin, are the most common. They are backed by reserves of traditional currencies or cash equivalents held by an independent custodian. For every stablecoin issued, an equivalent amount of fiat currency is held in reserve, ensuring a 1-to-1 value ratio. Companies like Circle, issuer of USDC, publish monthly reserve attestations for transparency. Crypto-collateralized stablecoins, such as DAI, are backed by other cryptocurrencies. To mitigate volatility, they are typically over-collateralized. This means the value of the cryptocurrency held in reserve exceeds the value of the stablecoins issued, managed on-chain through smart contracts. Algorithmic stablecoins, like the now-defunct Terra USD, aim to maintain their peg without direct asset backing or with only partial reserves. They use algorithms and smart contracts to automatically adjust the supply and demand of the stablecoin. If the price falls, the algorithm reduces tokens. If it rises, new tokens are issued. So, how do these intricate mechanisms ensure a stable value, even when the broader crypto market is in turmoil? For fiat-backed stablecoins, the process is straightforward. You can redeem your stablecoin for the equivalent amount of fiat currency from the issuer. This redemption mechanism creates an arbitrage opportunity, incentivizing traders to buy or sell to restore the peg if it deviates. Crypto-collateralized stablecoins use over-collateralization and liquidation mechanisms. If the collateral's value drops too much, it's automatically liquidated to maintain the peg. Algorithmic stablecoins rely on a delicate balance of incentives and disincentives, often involving a secondary token to control supply and demand. When the stablecoin's price falls below its peg, users are incentivized to burn the stablecoin to mint the secondary token, reducing supply. Conversely, if the price rises, users are incentivized to burn the secondary token to mint more stablecoins, increasing supply. Stablecoins offer numerous benefits, making them a cornerstone of the digital finance ecosystem. Their primary advantage is reduced volatility, providing a stable alternative to highly fluctuating cryptocurrencies for payments and as a store of value. They enable fast, near-instant, and low-cost cross-border transactions, bypassing traditional banking intermediaries and improving cash flow for businesses. Stablecoins are crucial in decentralized finance, or DeFi, serving as a stable medium for trading, lending, and borrowing, and hedging against crypto price risk. They also facilitate global access and financial inclusion, particularly in regions with limited access to traditional financial instruments. Like other cryptocurrencies, stablecoins benefit from blockchain's transparency, efficiency, and programmability, allowing for use in smart contracts and automated payments. However, stablecoins are not without risks and challenges. The most significant is the potential for depegging events. This can occur due to insufficient reserves, market manipulation, or flaws in algorithmic design, as seen with the collapse of Terra USD in 2022. Centralization risks are also present, especially for fiat-backed stablecoins that rely on centralized entities to hold reserves, introducing counterparty risk. Regulatory scrutiny is increasing worldwide, with concerns about money laundering, consumer protection, and potential risks to financial stability. Operational and technology risks, such as technical bugs, cybersecurity vulnerabilities, and contagion risk, also pose challenges. Stablecoins represent a powerful innovation, bridging traditional finance with the digital world, offering both immense potential and inherent challenges. Understanding their mechanisms, benefits, and risks is crucial for navigating the evolving landscape of digital currency. This is purely educational. Always do your own research, not investment advice.
If you want more crypto updates, market analysis, and breaking news, hit the subscribe button and turn on notifications.